The first thing to remember about ESG portfolios is that they are, first and foremost, a way of helping people reach their financial goals, which means they have to be effective from an investment perspective as well as being aligned to the values of the investor. The application of these values typically changes the holdings that are available for investment. This, in turn, affects the expected return, risk, and diversification of the portfolio. The more that an investor's values are applied to the portfolio, the more the characteristics of that portfolio change. For example, by applying a popular set of exclusions to the Australian market, you're likely to have a much higher exposure to healthcare and real estate and a much lower exposure to energy and materials. It's therefore essential that the expectations used to build ESG portfolios reflect the actual holdings in those portfolios and not the holdings of the conventional benchmark. Otherwise, it's a little like cycling around Sydney using a map of Melbourne. You're unlikely to get where you want to go, and you may have some nasty surprises. For example, a lower exposure to energy and materials is likely to make the portfolio more sensitive to inflation, while greater exposure to healthcare companies may reduce the sensitivity of the portfolio to economic growth. These differing characteristics of ESG portfolios need to be considered when building portfolios to ensure they remain robust and meet the long-term needs of the investor. To put it more simply, when traveling around Sydney, make sure you're using a map of Sydney. So we return to the principle that ESG investing is still investing. In practice, this means that we approach ESG investing similarly to how we approach all of our portfolios, with an added layer of consideration for aspects that are limited by having a smaller investable universe on offer. Thoughtful identification and understanding of investment objectives are still paramount, while the portfolio construction, asset class selection, and portfolio development require rigorous analysis, testing, and iteration to determine that both ESG and investing objectives are being met. At Morningstar, we're able to take this granular approach to portfolio building for several reasons. Firstly, robust analysis from our global team of investment professionals, as well as our access to the research produced by our sister company, Sustainalytics. The data generated by Sustainalytics is ideally suited to understanding the impact that selecting ESG characteristics will have on an investor's portfolio. We use this to help ensure that portfolios remain true to their values and are effective ways of helping investors meet their goals. Whether or not you currently recommend ESG portfolios to your clients, in a world where both personalization and the risks associated with the environment and social issues are becoming more prominent, it's essential to understand the fundamentals of ESG investing and the impact these choices have on your clients.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.